Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is October 28, 2024, and it is a weekly markets update. Let's have a look at the news of week 43 and see what are the next trends. Also, please check out my interview with Arjun Agarwal, Director of Nanofertilizers Private Limited, a producer of nanofertilizers from India, that was published last Wednesday. Arjun shared his insights regarding nanofertilizers' advantages versus standard fertilizers, as well as described sales strategies that can help to introduce nanofertilizers on a large scale across countries, so don't miss the jazz. This weekly review will not be usual because I'm still out of my office studio, traveling in beautiful Greece, where last week the largest European conference of Argus took place. So, taking into account that last week anyway was not very active in terms of trading activities, I will share with you some insights and gossips that were discussed during the conference. First comes urea, of course. The market is eagerly awaiting the next India tender, but in the meantime, market sentiment changed to bearish. There is no support for the prices that were achieved in Egypt several weeks ago, higher than 400 FOB. So there were unofficial discussions during the conference that Egyptian producers potentially would accept now as low level as $380 to $385 FOB. No official confirmation or any confirmed sales, of course, but still there is the level that is discussed. Sokar, Dangote and NCIC tenders announced last week closed with no buyers. Demand in Europe is stagnating with grain prices going down, thus fertilizers affordability will remain the key issue for upcoming months. Brazil demand is also limited, with many urea vessels being sold afloat at prices as low as $370 to $75 CFR, $5 lower versus a week ago. Urea prices east of Suez are more stable because producers are comfortable regarding November sales, and spot sales are mostly discussed for beginning of December already. New Indian tender will be anyways covered from Middle East and Baltics mostly, so there is no need for these producers to rush and drop prices now from the previous level of $375 to $80 FOB. Being here in Greece, of course, I couldn't resist and ask the Delphic Oracle about the future of Indian tender price. The Oracle indicated that this is one of the toughest questions that he ever had in his experience, but most likely the market will see a drop to the current level of at least $20. That's what he told. Regarding potential volume of the tender, 1.5 million tons at least is needed, Oracle told, but not necessarily we will see all of those volumes purchased during one tender only. Paper values dropped amid bearish sentiment in the market, except Middle East values for December that increased by $8 to the average of $375, while October and November values remained unchanged. Averages for Egyptian FOB declined to $380 in November and $379 in December. Non-FOB values also dropped to the average of $332 in November and $334 in December. Brazil CFR remained mostly unchanged. Ammonium sulfate market prices in China corrected downwards by a couple of dollars, both for standard and copra grade, mostly due to lack of demand in Brazil and Europe. Standard grade average FOB value is indicated at $140 FOB, while granular and compacted at around $160. In phosphate segments, there were discussions in the conference that perhaps market has already seen the price ceiling, and now the bears will enter the game. Seems like India could finally be running out of steam in its pursuit of DAP, as offers has softened for the first time in a while. Under a hurdle tender, offers were in the high 630s CFR, down from prices at $640 to $45 CFR the week ago. And further, for the end of Q4 and beginning of Q1, there might be no major buyers to keep the market up. And this might happen despite the fact that India hasn't purchased the full volume that it needs. Moving to the fundamentals. European natural gas futures climbed towards 43 euros per megawatt hour, reaching their highest level since December 1, up by 9% during a week, due to colder weather forecasts and geopolitical tensions. Predictions indicate colder temperatures in early November, leading to an expected increase in demand. Ongoing outages in Norway posed a risk, and additionally reduced wind output in Britain could increase reliance on gas for power generation. Geopolitical risks, particularly in the Middle East, have tightened the gas supply situation. EU gas stocks entered a net withdrawal phase on October 22 and 23, with storage levels at 95.3% full. US natural gas futures also increased to the level of $2.5 per MMBTU. From the one hand, meteorologists predict warmer than normal temperatures across the lower 48 states through at least by November 9, and this will likely reduce heating demand. From the other hand, analysts project that average natural gas output in 2024 could decline for the first time since 2020. Additionally, overall LNG feed gas supply is expected to remain below record levels for the next few weeks, as some companies perform maintenance on their facilities in Louisiana. Agricultural commodities future prices showed diverse movements last week. Wheat futures fell to $5.7 per bushel, marking a one-month low, as rain was predicted for dry wheat regions in southern Russia and the central US, though drought remained a concern. In the US, the rain fell across much of wheat-growing areas, but its coverage was spotty and perhaps will be not enough to prevent further degradation across most of the plain states. Price in the Russian ports decreased as well. However, a substantial slowdown in shipments is expected soon, which could in turn support global prices. Corn futures rose to 4.2 per bushel, reaching a two-week high amid strong demand and certain supply concerns. Robust demand from the ethanol industry supported the prices. Current estimates show that corn bushels used for ethanol production are slightly below the USDA's target of 5.45 billion bushels for 24-25 year. However, ethanol production typically peaks in the summer when driving demand is highest. Additionally, supply disruptions in Ukraine and the Middle East further impacted the market, with concerns over exports from the Black Sea region contributing to global supply constraints and subsequent price increases. Soybeans futures rose to $9.9 per bushel, extending the rebound from the near two-month low touched on October 18th, benefiting from stronger demand for biofuel alternatives. High-risk premiums for crude oil futures due to geopolitical tension in the Middle East raised the price for soybean oil, the largest feedstock for biodiesel in the US. In the meantime, reports show that foreign buyers increased orders to take advantage of low US prices. US farmers are harvesting the largest soybean crop in history, at the fastest pace in years, straining their storage capacity. Additionally, the large crop in Brazil prevented a sharper rebound. Moving to the shipping industry. Containerized freight index rebounded a bit, adding about 130 points versus a week ago. Rates for containers on the route New York-Rotterdam increased significantly, while rates for all other directions, especially from China, continue decreasing. The Baltic Exchange Dry Index collapsed by another 130 points in a week. Declines in rates were regions across segments. The week was very difficult, with almost no demand both in Capesize and Panamax in both basins. At the same time, the Ultra-Supramax segment had some vivid activity registered in the US Gulf as well as in the Mediterranean, but in other regions the activity was subdued. In the Handysize segment, the market saw mixed activity, with some good demand in the Mediterranean, US Gulf and South Atlantic, while in the Pacific the market sentiment remained soft. To sum up, the market is eagerly waiting confirmation of Delphic Oracle divinations regarding the next Indian tender. that is expected to collect at least 1, maybe 1.5 million tons, most of it for the West Coast, with prices lower at about $20 versus current level. On this background, also supported by sluggish demand in Europe and Brazil and lower fertilizers affordability, the market starts to switch to the bearish sentiment. Similar happens in the DAP segment, where market is started to expect India to purchase more, and prices start sliding. Colder weather in Europe and geopolitical tensions in the Middle East that might affect supply stability drove European TTF gas price higher. In the US, gas price also increased amid expectations of the decrease of the country's output for the first time since 2020. Wheat futures dropped due to the start of rainfalls in the producing regions, while corn and soybeans futures moderately increased on the background of healthy demand, specifically for the biofuels. In dry bulk shipping, the market is transitioning into the low-volume holiday season, and thus index dropped again, while containerized index rebounded a bit first time in the past 3 months. So, let's see what is next around the corner. But it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.